Quantitative analysis involves studying the numbers and applying factors to understand and predict investing strategies that have and should continue to work in the market. To determine whether these factors are effective or not, they typically run backtests on them. A backtest means using historical stock market data to test out the performance of a factor or model. Let's look at an example. Let's say we come up with a hypothesis that companies that trade under their net asset value tend to be good companies to invest in. This hypothesis leads to the model that says companies that have a price-to-book ratio of less than 1 should tend to outperform their peers that have a ratio over 1. It should be noted that this is a common value factor known as price-to-book value. This model is then tested over some number of years using real historical stock market data. After this data is compiled and examined, the model can be accepted as generally true or generally false. The common benchmark to assess these backtests and their relative performance is the S&P 500 index. This forms a sort of experimental control benchmark. If the positive of the model is above the benchmark and the negative of the model is below the benchmark, then one can conclude that the model has some amount of predictive power and is then normally termed a factor. Depending on how well the data fits, factors can then be subdivided into strong and weak factors. This type of cycle will be repeated over and over in an attempt to find factors that have worked in the past and what has the probability to continue working in the future.